of rules when it comes to these things. So my goal today is that we'll give you a brief overview of what long-term care is, also what long-term care insurance is, and how that might benefit you from a financial planning standpoint. As Melissa said, please feel free to jump in and ask questions as you feel it necessary. You don't necessarily have to wait for them till the end. We'd love to just answer them as we go along. So let's jump in. So you can see here, maybe.
Yeah, we're seeing your screen. It looks like it's stuck on the first slide.
I see that. Of course it is, Melissa.
Yeah.
All right. Give me 1 second.
Thanks for being patient as he gets his PowerPoint back up and running again. It's always something with these webinars.
You can plan and plan as much as you want, and it's still not going to work out.
Right. Like yesterday, I did a webinar with Steve Bustos. He did one on Meet Everence, and we were having some problems having him log in. So he logged in as me, and so his whole PowerPoint, he was there with his screen, and it said Melissa Short for him.
All right, we're good?
Okay, yeah.
All right, great. So let's start with what is long-term care. So long-term care itself is really a wide range of services. Most people, when they historically think of long-term care, they're going to think of the nursing home. But the reality is long-term care really is a wide range of services, and it's not just skilled full care facilities. And it's the services provided to people who have lost the ability to care for themselves. Now, what could cause this? Well, there are a number of reasons that this could happen. Probably number one reason we think is medical issues. Just the old age, not being able, losing function just from any type of medical issues. The other one that a lot of people are probably most scared of is cognitive impairment. Those are the ones that we see, long-term care stays. Many people think of Alzheimer's and things like that. And then finally, just the result of the aging process, just the natural aging process, not being able to care for themselves. So just keep in mind, it's really not all just that full skilled care. There's a lot of different reasons and then a lot of different services that could be provided. When you think of long-term care, you may have heard of these. These are activities of daily living. And where these really come into play is looking at long-term care services and maybe what is needed. And so these activities of daily living are 6 areas that are designated as reasons that people may need long-term care. And especially when you look at long-term care insurance itself, that is really going to come into play. And so those 6 activities of daily living are, number one, bathing. And it's not just the act of bathing, but it's maybe getting in and out of a tub or a shower, those types of things. The second one is continence. And so this one basically is controlling bodily functions, but also it's personal hygiene, not being able to keep up with personal hygiene. The third one is dressing. And so that's the ability to obviously put clothes on, take clothes on and off. Fourth one is eating, and it's not just eating, it's also preparing meals, the inability to get those meals prepared. The fifth one is toileting, getting on and off of the toilet. And then the sixth one is transferring, maybe transferring in and out of bed or transferring in and out of a chair or something like that. And so when we look at these activities of daily living, that really determines the level and the skill of care that we need. But it also determines, when we look at long-term care insurance, most of the time, and we'll talk a little bit about that later on, most of the time long-term care insurance is triggered by 2 of these 6 activities of daily living. So if you need help with 2 of the 6, that's a lot of times when long-term care benefits will end up to start to get triggered. Interestingly, the one that folks lose most often is the bathing. So it's kind of a neat tidbit there. That's the one that's kind of the first one to go. So we know what those activities of daily living are. We know what long-term care is. What are some services that you could actually use for long-term care? Well, the first one that's becoming increasingly popular is home health care. And we'll talk a little bit about that. The second one that we'll talk about is community care. Things that are in the community that aren't necessarily considered skilled nursing facility. Assisted living facility is one that's become popular in the last, 20 or 30 years. And then finally, the nursing home care, where we may need full skilled care. So those are the four that we'll talk about where we could receive long-term care services. Of course, I'm locking up again, Melissa.
Oh, okay. Well, we'll do this again. Thanks for everyone's patience. Where are you today, Craig?
In Archibald, Ohio.
Oh, okay.
You're familiar with that one?
Yeah, very familiar with Archibald, Ohio.
So home health care.
Okay.
There's really two ways of doing home health care. And what we found, there have been studies that have been done that up to 60% of all new long-term care health insurance or long-term care insurance claims are actually used for home health care. And the reason behind that is people just really want to stay in the home longer. The policies that are being written are more generous when it comes to home health care benefits. It used to have to be where it was a rider that you'd actually put on top of the policy. But most people are wanting to receive care at home. And so you can see primary care there. It's administered in the home. It could be provided by family members or friends. So a lot of times you'll see husband and wives. Obviously, they want to take care of each other as long as possible in the home that they've lived in for a very long time. It could also be assisted by professional caregivers. So some skilled care could come in to help prepare food, to help transfer in and out of bed, to help bathe. So those activities of daily living that we talked about a couple slide ago, somebody could actually come in and assist with that as a professional caregiver. Now, at home, there's two types of providers. One is the informal, and the other one is a professional provider. The informal caregivers are things like the home health aides, personal care assistants, certified nursing assistants. So those may be more along the lines of coming in and, like I had said, helping prepare meals, helping give medications, those type of things. Then you have more of your professional caregivers, registered nurses, licensed practical nurses, physical, occupational, or speech therapists that may actually come into the home and help with those skilled services. A lot of times, you may not need 24-hour care at home. That a nurse or a LPN will maybe come in and help with a couple hours a week with certain activities or things like that. So there are a lot of different ways that you can receive skilled care at home. Let's talk about home healthcare costs. Now, this is obviously, of all of the costs that we have, this is going to be the least cost. And so to have a home health aide come in, the national average, and again, we really can't provide you with a state specific, but there are websites out there that you can actually go see what your individual state is for these types of costs. A home health aide national average is about $19 an hour, or for an 8-hour day, $152. So as you can see, it could get very expensive by the time, even for a home health care aide to come in and do that skilled care. So at 152 times 365, that's almost $56,000 a year. So it can be quite expensive even being at the home. Oh. We have to work on this for the 8 p.m., huh?
Yeah. What is the deal?
The second one is the assisted living. I'm just going to keep it here and see if it does better. The second was the assisted living facility. And so those are becoming more popular over, like I said, the last 20 to 25 years. And so those are apartment or condominium-like settings. They provide 24-hour assistance with personal and custodial needs. And again, that's the 2 or more activities of daily living. So think of the assisted living facilities as an apartment where you have things available that are around you to help with anything that you may need. Where somebody may be available to come in and help you cook meals, or maybe you have the ability to go to a shared cafeteria or something like that, where everything is kind of around you and available, but yet it's primarily independent living. Those assisted living facilities are quite a bit more. The national average, as you can see there, is about $3,400 a month. And so those are nice because they're cheaper. They're cheaper than a home health aide because you don't have a nurse traveling back and forth. But they're nice because you have everything there, but they're still awful expensive when you get down to it. Like I said, for most folks, the progression is home health care, maybe into assisted living at some point. And then a lot of the CCRs or care communities actually have everything tied in together. So they have assisted living and they have a skilled facility all in the same complex or same campus where you can go from one to the other. Finally, the last one is nursing facilities. So these are where you have the skilled, intermediate, or custodial 24-hour care provided by licensed caregivers. So you're going to have nurses there full-time. You're going to have doctors there full-time. There's going to be people there full-time to provide care. This is what you think of your typical nursing home or long-term care facility. And so for a cost there, you can see that it's going to vary widely by city and state. So first thing you want to think of is, are you in a metropolitan area or more of an urban area, or are you rural? And so metropolitan areas, Chicago, those big cities are obviously going to be much, much more than potentially a rural area that maybe does not have as much need there or as many people there. For example, though, just to give you an idea, $258 times 365 gets you to about $95,000 a year for an actual private room. So this is obviously going to be your most expensive option going forward. So those are really the four areas, the three areas that you have the most skilled care services that you can access. That's great. What is the risk? Well, this isn't even going to help, Melissa.
Ah, the gray screen of...
So about 70% of people older than 65 will need long-term care services at some point. So if you get to 65, there's about a 70% chance, or a little over 2/3 chance, that you're going to need some type of long-term care services. Now, it does not necessarily mean that it's going to be the full skilled care long-term stay, but it could be something as simple as having an at-home care or at-home nurse come in and help with things. So what is the risk? Well, again, about 12 million Americans currently need long-term care services and support. And this one always gets me. About 44% of people now receiving long-term care services are between the ages of 18 and 64. So that's kind of a scary number for a lot of folks. We think of needing long-term care services as something that is in your 70s or 80s or even 90s. But the reality is about half of the people that are having long-term care stays now or needing services are under the age of 65. Now that could be for a variety of things. It may be more accidents and health issues as opposed to the natural aging process. But it's something that's kind of eye-opening, that you don't necessarily want to wait till you're 65 to start looking for long-term care services and long-term care needs. So why would you want to own long-term care insurance? Well, we see this for a couple different reasons. The first one is asset preservation. Essentially, you hear it all the time. You don't want your assets that you've worked hard for to go to the nursing home or go to an assisted living facility. So that's the main reason that people would really want to own long-term care insurance. I always say long-term care insurance is like retirement income insurance, because those assets that you've saved a very long time to preserve and to accumulate, the income that you're getting off those assets in retirement can get taken away in a heartbeat by a $90,000 stay. So that's one of the reasons that you'd want to look at doing long-term care insurance. Now, there's all ends of the spectrum on long-term care insurance. At the beginning, you heard me say that it's so individually specific. There may be about 10% of the population that really the assets don't necessitate buying a long-term care insurance policy or doing long-term care insurance, just because they're just not enough to justify the premium. At the opposite end of the spectrum, about 10% of those folks, we don't run into these too often, but they have so many assets, so much assets that they can afford to self-insure almost. They're not worried about that asset preservation. And then there's the middle 80%, which is the majority of folks, that they need to at least take a look at it to see if it makes sense financially for their specific situation. The second reason to own LTC insurance is really for the family. Is the family available to help with long-term care needs? Is a son or a daughter available? Do they work full-time? Are they willing to help out? Or are they even geographically in the area? These days, kids are moving away far more than ever. And so are they going to be willing and able to step in and help? So that's where long-term care insurance could be beneficial, is that you can pay for that home health aide or that caregiver to come in where maybe a son and daughter would have been able to a long time, 10, 15 years ago, but kids are moving away at a greater rate these days. The third one is quality of care. Long-term care insurance gives you the ability to choose your quality of care. Maybe you like a certain geographical area that you want to stay in. You want to stay around your grandkids. There is the ability with long-term care insurance to choose that facility maybe that you may want to reside in. Facilities are changing all the time. Facilities are getting better and better all the time. It allows you to pick and choose a little bit more. Maybe not pick and choose, but have flexibility in your quality of care. And then the fourth one is the financial safety net. Again, they just don't want to have to worry about things in retirement, and healthcare costs and long-term care costs are two of the most significant expenses that can come about in retirement that could eat away at that savings and that income. So is LTC the insurance the solution? Is long-term care insurance the solution? Well, it could be. Long answer, easy answer to a long question. It could be. Number one, it could help provide money to pay for long-term care expenses. It could assist someone in really maintaining independence. Again, going back to the home health care, most folks really want to maintain independence at home health care or assisted living as long as possible. So it gives them the ability to do that. The choice of how and where care is provided, and then finally that safety net, that peace of mind that they have the ability to pay for it if it does arise. So at its core, let's talk a little bit about long-term care insurance. At its core, long-term care insurance, I always say it's like buying a car. There are so many different bells and whistles, options that you can add to a car. You can get this feature or this feature. And the reality is long-term care is the same way. You can do add-ons for absolutely anything that you want. And so it can also almost be overwhelming. And so long-term care insurance at its core, you have all these options that you need to choose. But it really comes down to 4 options. And I don't have these listed, but I want to tell them to you. The first one is going to be your daily benefit. So how much do you want that daily or monthly benefit to be? You saw the statistics as far as costs. Most daily benefits end up starting around $150 a day to $250 a day. So the question that you have to ask, and it's like when you buy a car, the better the option, the more expensive it gets. The same premise here. The better your options, the more expensive it gets. And so taking a look at that, I recommend most people start looking in the $200 a day range. But I've seen folks do kind of each end of that spectrum. So number one is daily benefit. The second one is, how long do you want that benefit to go for? What is your benefit period? And so those are going to range all the way from 1 year all the way to lifetime benefits. Lifetime benefits, as you can imagine, are going to get really, really expensive. That's part of having the lifetime benefit. Most of the time, what we recommend, if you're looking at traditional long-term care insurance, is to look for a benefit period of anywhere from 2 to 3 years, 2 to 5 years. And what that does is that's going to cover the average stay that somebody may have. Statistics tell us that if you have a nursing home stay, this is more skilled care facility stay, you're going to be there for anywhere from 2 to 3 years. And so that's going to at least cover that if you know that event may potentially happen. So the second one, first one is benefit amount. Second one is benefit period. Third one is the elimination period. And so what the elimination period does, think of it like a deductible in health insurance. There's going to be a time period, just like a dollar amount in health insurance, where you're going to have to pay out of pocket before the actual policy kicks in. And so that deductible period or elimination period basically goes from 0 days to most of the time 365 days. So from 0 days to a year, where you would have to pick up the cost for any long-term care services before the policy would kick in. Now, most policies are going to kick in when you have those 2 of 6 activities of daily living that you need help with. Most of the time, probably 95% of the ones I've ever seen are a 90-day elimination period. Why is that? Because most people can carry 3 months if they need to, if they need to have services, and it tends to work out for the best bang for your buck. It's the most price efficient point. So 90-day elimination period is what most of the time happens. And then the fourth thing that you have to choose is your inflation rider. Now, inflation is one of those things that, because cost of long-term care services are going up so rapidly, not as much anymore, but they're still averaging sometimes in certain areas 6-7% a year. Inflation protection is something that you can add on to the policies, and we normally recommend it. Those can be anywhere from 3% to 5%. Some can be simple and compound. I've seen some that have cost of living adjustments. So really, every policy is going to be a little bit different. Most people end up looking at the 5% compound. Obviously, it's going to be a little bit more expensive, but what the compound does, if you have a $200 daily limit the first year, it's going to add on another $10, so $210, and then it's going to compound from there. That's nice because it's not meant to keep up with the cost of coverage, the increase, but it hopefully will help some towards that. So those are the 4 key areas. It used to be that you have to have a home health care rider on it, so that was the 5th area, but that one's kind of gone away because most of them are standard now that you would have home health care covered. Let's talk a little bit about partnership. This is something that has been more and more common in the last 15 years, that states have come out with partnership insurance policies. So now, again, this is traditional insurance, those 4 key areas that we had to talk about. And so every state is going to be different on this. Each state basically has come out, most of the states have come out and done partnership plans. And what that basically means is there's a partnership between the insurance company and the state Medicaid program, to where if you purchase a long-term care insurance policy and you exhaust those benefits. So let's say you purchase a policy and the total policy benefit, that's the daily benefit times the year, or times the length, that total benefit gets exhausted. you can exclude whatever that benefit was from the qualification for Medicaid. So let's look at an example. If you have $200,000 in benefit and you go in for a long-term care stay need and you exhaust that $200,000 in benefit, you can exclude $200,000 from your qualification for Medicaid. Now, depending on how you feel about that, I've had differences of opinions all across the country on that. What I think it does is it gives you some options. It gives you the ability to do some different things. So that gives you an idea of what the partnership plans are. Each state is specific. For example, Indiana, Connecticut, New York, and I think California. I think those are the four. So Indiana, New York, Connecticut, and California were four original partnerships or total asset protection states. So you have to check if your state is that, if they're still that, because I don't deal in all those states. But for Indiana, for example, if you purchase a state set amount and it's about $370,000 in benefit, and you exhaust those benefits, you can protect every asset that you have from the qualification of Medicaid. So there are certain states that have different rules there, but it is a very nice feature to have. What does it need to do? Well, the differences are really not that great between a partnership policy and a regular policy. To qualify, you have to be tax qualified. Most of the policies are tax qualified anymore. The second one is you have to have that compound inflation protection that I talked about. So age 18 to 60, it's required. You have to have that. 61 to 65, you don't have to have compound. You could have some type of inflation. So it could be just simple or compound. Simple just basically means that if the $200 a day, it's going to add $10 every year. Compound, it's going to keep going. Age 76 and older, inflation protection isn't required. So not a huge, long list of classifications to be able to be a partnership policy. So it's important that if you are looking at long-term care, that you take a look and see what the rules in your state are. One other thing that I will add, a lot of people move. If you buy a partnership policy in Indiana and move to another state, it's my understanding that that partnership policy will now go to the new state. So for example, if you do dollar for dollar, if you do total asset protection in Indiana and then move to Florida, you would lose that total asset protection. Now you'd be down at whatever Florida's rules are, which I'm guessing are probably dollar for dollar. So an important distinction when you're thinking through this process is, where might I end up and do I need to account for that going forward? So that's the traditional long-term care insurance. That's the partnership plan. When you take a look at long-term care insurance, it's obviously, there's a lot of options. It's a very, very confusing solution to most folks. The game has changed a little bit. And one of the main questions or objections I get to long-term care insurance when I'm meeting with clients is, what happens if I pay all this premium and I never end up using it? It essentially goes to the long-term care, to the insurance company. And the reality is, yes, it would. And so insurance companies have gotten smart and said, well, that's unfortunate. Why can't we do something different? And so they've come out with what we call hybrid plans. And so basically what these hybrid plans do is they take away that question of what happens if I never use it, I lose it. And so it basically couples a life insurance or an annuity with a long-term care rider. And so how these work are basically, we take a look at your situation. It works very similar to the traditional long-term care in that you kind of have a daily benefit. You have a length of period. You have an elimination period. So you have all this stuff kind of associated with it. And the life insurance is kind of the core product, or the annuity is kind of the core product, where if something were to happen to you, you would get that benefit, your beneficiaries would get that life insurance benefit. So if we pay premium and then 4 years down the road, we never use our long-term care, it would get paid out, and something happens to us, it would get paid out as a life insurance benefit. So it takes away that what if scenario. These can be done with IRAs. You can fund them with IRAs. We've got some clients that we're funding it with an IRA rollover into an annuity, where it's an IRA that comes in, it's in an annuity, it has some returns, albeit relatively small, but it has the ability to enhance the value for long-term care services. So there's a lot of different things that are out there now that may be applicable. The game has changed quite a bit when it comes to long-term care insurance. And so there's a lot of options that you want to consider, and maybe what would be the most appropriate plan for you. The only downside, one main downside of the hybrid plans is that majority of them don't have a cost of living increase or a compound inflation rider. The new ones do. So it's working with your advisor, whether it's Everence or other advisors, working with them to try and make sure that, what is the cost, what is the benefit. It's still a lot of options, but walking through those. So again, kind of life insurance with the long-term care rider, your protection is there if you need it. One of the nice benefits there is we just did one on a client. They can get lifetime benefits. And so those are kind of going away a lot of the times in the traditional long-term care market. So lifetime benefits are becoming options, and relatively affordable. It's still a very expensive solution, but it's relatively affordable. Oh, it did it again. We were doing so well. I think I'm going to do a PDF for the 8.
Okay.
I think I'm going to do a PDF for the 8.
Okay. What is it?
We're almost done. Okay, so again, kind of back on the hybrid plans, several ways to cover this cost. Everything has different options, different terms. The big thing is consult with a professional, make sure we take a look at what assets you have and what would be the best way to go about it. One of the questions I always get is, wait, what about Medicare? Well, Medicare really isn't designed to cover long-term care services. One of the big hangups in Medicare is you have to have a hospital stay of 3 consecutive days, not counting your day of discharge. Well, there are a lot of people that maybe go from home health care into an assisted living or a long-term care facility. That's not going to work. Or just having a hospital stay for 3 days beforehand is very rare. So that is going to limit a lot about what we'll do. And it must be admitted for a related illness or an injury. So if you have if something happens, maybe you have a heart attack and you're walking down the stairs at the time and you break something and you have to go to rehab for that. Well, it's got to be for a related illness. So there's a lot of criteria that have to happen. So the big thing is Medicare is really not designed to do that. It does have some ability to pay. It does play days 1 through 21, again, if all those criteria are met. So it pays 20 days of costs. 21 through 100, you pay the first $144 a day, and they pay the difference. So again, not a great benefit there. And after day 100, Medicare pays nothing. So it's not really designed to help with the long-term care costs. What about Medicaid? Well, Medicaid, again, is available only to certain low-income individuals who fit into eligibility. It's recognized by state law, so every state's a little bit different. Most of them are around $1,500 to $2,000 in assets, which is really low, and very little income that's coming in. So Medicaid, a lot of times, is very difficult to qualify for. Or you hear it all the time, spend down your assets for Medicaid. Medicaid spend down. So that happens quite a bit. The amounts differ by state, so they're going to vary by state. They're updated every year, and it's different requirements based on your marital status. So if you're married, you may be able to keep a home or keep certain things. There's different requirements and different options for each state. I thought this was an interesting slide. What are the ifs? Well, you must meet those state-specific asset requirements. What are countable? Well, stocks, bonds, mutual funds, CDs, bank accounts, personal and real property, art and collectibles. Those are all countable assets. So you would have to liquidate all of those before that time comes, before you would qualify for Medicaid. I have heard thoughts and rumblings about IRAs being not countable, but I don't personally think they're going to go that far with it. Non-countable assets, things like primary residence and household goods, any income-producing property, burial plots. And one of the reasons income-producing property is a non-countable asset is because it's going to go under the income category instead of the asset category. Burial plots, personal effects, they're not going to take the clothes off your back, but about everything else. And then finally, how about VA benefits? Well, if state and specific, if space and resources are available, they do provide some nursing facility care. Veterans with services-connected disabilities are given first priority. You have to have a service-connected disability rating of about 70% or more in total disability based on individual unemployability. The thing I recommend, if there are any veterans on the call, contact your VA for questions regarding the eligibility, because quite frankly, that's not something that most advisors end up dealing with on a regular basis. Well, I am at about 40 minutes, which is about what it's designed to. I want to pause and just see if there are any questions. Melissa, do we have any chat questions or anything like that?
Okay, well, thanks, Craig. No, not at the moment, but feel free to send in your questions. We won't keep you too long, but I'm sure maybe some of this has raised some questions for you. So send them our way. We thank you for coming in and sitting through this webinar. It was very informative, and we're sorry about our little glitches, but yeah, you can see the real real work behind this. Okay. Well, I'm not seeing any questions right now. Okay, we do have a question. And this one is from David in Indiana. He asks, did you mention buying an insurance policy with the pre-death benefit draw? Yep.
So that would be the long-term care life insurance kind of combination policy, the hybrid policy. And basically how that would work is, let's say, I'll use my example of the $200,000 policy. If you have that $200,000 policy and you access benefits, it draws that death benefit down. And so at some point, if it exhausts benefits, most of them have a small benefit that's available, $25,000, so that there is some death benefit still available. But if you don't need it for long-term care services, it'll just go as a traditional life insurance policy.
Okay, thanks. And here's another great question. Well, first he asks, you see it, okay, I'll say it to everyone, how is long-term care insurance superior to investing money? And then he asks, to rephrase my question, do insurance companies expect to make money or lose money on long-term care?
Yeah. So they lose money, and most of them anymore probably don't lose money as much as the ones that were purchased a number of years ago. So long-term care started back in the late 70s, early 80s. It got more and more popular, and everybody and their brother that was an insurance company was getting into the long-term care industry. And what they were doing is they were pricing the plans, not thinking of what the costs were going to go to. And so they have gotten to a point where they are losing money based off of that. Now, what does that impact? Well, it doesn't necessarily impact their ability to pay claims. Most of the ones that have gotten out of the business, at least the large players, the large insurance companies, most that have gotten out of the business have continued to pay claims. They've committed to pay claims, and they've done a pretty good job with it. But what it has done is it has gotten them out of doing new business. There are only about 3 or 4 large long-term care insurance carriers out there anymore that do the traditional long-term care. There are still quite a few that do the hybrid, the long-term care and life and the annuity. But most companies historically have ended up losing money or not made a lot, like you would think insurance companies are going to make money quite a bit, but not typically on a long-term care policy. And that's, that's one of those things where they can also, like a lot of the long-term care insurance, the traditional ones, they can raise your premiums. They don't do that all that often, but they do end up doing that every once in a while. And they have to do it as a group, so they can't target an individual.
Okay, thanks. And you can see there's another question is asking about an opinion about an advanced life deferred annuity that typically starts to pay out at age 85. Your thoughts?
Yeah, I mean, the only thing I see that could be the problem is as you saw from some of the statistics, it could happen anywhere from 65 to, it's likely to happen earlier than that. So I would say setting up an annuity and having the ability to pay out at some point is not a bad option. For that scenario, so setting up an annuity, having it in the accumulation phase, but having the ability to flip the light switch off when long-term care may be needed and provide income, that may be something. I don't know that I would start an annuity having a preset selected option of it paying out at 85 in case they were needing access earlier. But the annuity long-term care hybrid policy may be a good option for that, because you can keep it in that savings area until long-term care is needed, and then it automatically flips on the light switch or flips on the switch to pay out whenever you do need it, and you could set it up to where that goes, through life.
Okay, thanks, Craig. Here's another question. It's from, my wife and I are both 60 and evaluating our needs, but we hear from a number of people that long-term care is a waste of money. Why is there that view, and how can we be sure we will indeed benefit from long-term care insurance?
Yeah, it is a difficult decision, especially from the traditional standpoint. All insurance is tricky. Let's be honest, that's the reason it's insurance. From the traditional standpoint, there are no guarantees that you're ever going to need it. And so that's where we see a lot of it is, well, that's a waste of money, because let's say I never need it, it just goes to the insurance company. And I completely agree. We don't do a ton of the traditional long-term care insurance anymore for members just because of that fact. Unless you see like the partnership plans that I had talked about, where there's a specific reason that they can hide assets or protect assets, or I guess are a better word. The long-term care life annuity kind of hybrid policy, that actually probably is one solution that is more palatable, a better solution for some folks, because they can get some gains on the account. They can get a little interest on the account. Is it going to be the cheapest? Can you go do a better, invest better outside of it? Absolutely. But it is there to serve a dual purpose. So that, if you have a guarantee that you're going to get your money back, if you never need it, or even if you pass, if something happens to you, unfortunately, over the next year, you're going to, that's a life insurance benefit that you're going to have paid little for. So those make more sense for somebody that's really concerned about the waste of money deal, because you can get something back off of it.
Okay, and um, yeah, I'll just do one or two last questions here. Um, is the cost of long-term care like insurance that does it, and he rephrases it, that does it cost more the older you are?
Yes. So, and it's exponential. So it's not a straight line curve. If you're 55, it's this, and you match it up, and it's 65. It goes on a bell curve. So the older you get, the greater increase the cost is. So something's gonna, the chances of something happening are greater from 64 to are greater from 84 to 85 than 64 to 65. So it gets exponentially higher. Probably the best, what I recommend for most clients as far as a time frame to look at it is from 55 to 65. If you get past 65, it could get cost prohibitive. Not to say it always is, but medical issues and things like that, that's kind of the sweet spot range to at least start looking at it.
Okay, great. Well, thanks. We've got a lot of interesting questions, and yeah, it gave everyone a lot to think about. Um, yeah, at this point, I don't see any more questions, and I don't want to keep you much longer. Any last words, Craig?
No, I mean, yes. The only thing I would say is talk to some. This is something that this is a solution that we do. One of the we do a lot of solutions for folks and help them with a lot of issues. This is one of those that research is key. Knowing it's the most complicated product thing we do, and so using an Everence advisor, if you have one, using some type of advisor, going to research on your state website. There are a lot of things that you can look at and opinions that you can gather. This is one of those critical things to do. One of the solutions that we do that would be critical to get help with. A life insurance policy, we'd love to help you with that too, but if you're doing term, there's only so many options. This is just a lot more complicated than that. But thank you for your time. I hope you enjoyed it. If you have questions, if you have questions that you think of later, please relay those to Melissa, or if you want to get a hold of me and talk in person, relay that to Melissa and she can get a hold of me.
Yes, I'd be glad to forward any questions or comments you have to Craig. Well, we thank you so much for joining us for this webinar this afternoon, and we hope you learned a lot. And yep, and as always, stay in touch. We offer a variety of webinars, and at this point, I'll be signing off. Bye, everybody.